So here's a company I would never invest in. This company has Snapchat, and if you look at their performance over their life, they went public in 2017 at $24 a share. It got as high as $77 during the pandemic, and now it's $7 a share. So if you had bought this 8 years ago when it came out because it was a hot stock, you would have gotten nowhere. When it came out, if you had invested in the S&P 500 index fund, you would be up 156% versus investing in Snap, where you're down about 70% if you held it. And sometimes if something gets cheap enough, it gets interesting, but this is not cheap enough to get interesting for me. So as I said, anything that I invest in, you should compare to the default, which is the S&P 500. And the S&P 500 currently is very expensive. Instead of the average 15 or 16 times earnings, it is currently about 32 times earnings. But Snap, which owns Snapchat, does not make any money. It loses money at negative EBITDA. In order for you to find good companies, you always have to turn over a lot of rocks. And the only way you can turn over lots of rocks and keep looking for things is if you get rid of bad ideas quickly. And this is a bad idea, and it's easy to get rid of. It has done terribly over its lifetime. It hasn't made any money. And even though some people like to talk this up, I will show you something that you should look for every company, and it'll tell you whether you can quickly get rid of it or decide to dig deeper if something is cheap enough. So this is the number of shares outstanding from when it went public to now, and as you can see, that's going up. So if this company was making money and they were issuing more shares, you're getting diluted, so it kind of cancels each other out. The only way that it would make sense is if they're issuing more shares, but the share price is going higher than the number of shares they're issuing percentage-wise, it might work out. But what you'd rather see is a company that's buying back shares, so the share count is going down, or a great company that is, even if it's not going down, at least it's not diluting, like Coupang. But a company like this, where it loses money and they just keep issuing shares, even if it makes money, you're probably not going to do well. And again, this is an investment advice. This is just me walking through my process. And the worst thing about this company is the stock-based compensation that they give to executives. So this company, the whole market cap is less than 13 billion, and last year they paid out over $1 billion in stock-based compensation to their executives. So the company's losing money, hasn't gone anywhere since it went public. They're issuing more stock every year, and they're issuing it to insiders. So it's not quite 10%, but it's pretty close that they're just giving to insiders on a company that's losing money. And if you do that for 10 years, they're going to own the whole company, right? So this is one that's an easy pass. And if you're going through hundreds of companies, you need to discard them as quickly as possible when you see something bad and just move on. As Warren Buffett said, there's never only one cockroach in the kitchen. If you see one, there's probably others. So when you see a problem, just move on to the next one. Don't try to convince yourself that you can keep digging and find something valuable in there. Anyway, not for me, but if you guys have any opinions on this or any stocks you'd like to see, just leave them in the comment below. Have a great day, everyone.